All right, as promised, we're going to bring in Tech Trader to discuss all things NASDAQ and whatever else he wants to talk about, I suppose. But first and foremost, good morning, Sean.
Good morning. How are you?
I'm doing okay. Quite a volatile ride in the NASDAQ today. Actually, we've come off this some weakness, saw a big rally on Friday, a little bit yesterday as well. Here we are, we dipped back down. What's going on? What's your take on this whole NASDAQ run?
I actually very much like the tone of the rally. The very first day of the rally, which ended up failing miserably, and then we went to a lower low. And what was that? Like midweek last week. Might have been around the time we last talked. The sell-off started. We had one bounce day. I think you asked me what I thought. I'm like, well, I mean, maybe it's good enough, but I kind of thought, or I definitely thought that we had more, right? And I think I even said something like, look, I think we can correct close to 10%. And the NASDAQ, I think, ended up doing about 10.5. And I wouldn't have been surprised, by the way, if we would have gone even deeper. Something sort of saved us. Was it somebody's earnings report? I'm trying to remember that there was something. Oh, it was basically the economic reports. There was an earnings report or two, by the way, that came in pretty decently. But I think it was a lot of economic data is coming in soft. Now, I think you remember what I said. I said that I didn't think the sell-off had literally anything to do with rising rates or a fear of the Fed overshooting. I think that was, the media is always going to find a narrative. They're always going to try to find something to rationalize moves in the market, especially in the moves in the market. A lot of times, or many times, are irrational. This is one of those very rational, long overdue sell-off, and I think that the sell-off had everything to do with the second phase of the unwinding of the FANG sort of cloud bubble. And again, the easy excuse was rising rates. But if you really look at rates, and if you want to really compare the magnitude of the increase in rates versus where they were 6 months, 8 months, a year, even 2 years ago, the long end of the curve really hasn't changed much. 30-year and 15-year mortgage rates have not changed much at all. Maybe mortgage rates are up, 35 to 40 basis points in something like 2 years. That's very negligible. And in fact, I would have thought, just given sort of general global and U.S. sort of healing, prosperity, sluggish growth over the last 2 years, and the U.S. has grown better, I honestly, I would have thought that just the natural long end of the yield curve would have risen more than basically 40 basis points for 30-year fix. So anyway, we'll see how all that unwinds. I do think we will eventually get a sharp correction based on rates, but I don't think this is it. If we get a sharp correction based on rates, it will look a lot different than this last correction looked. And you know what this correction looked like? It was basically a complete echo or redo of the correction we had in the spring, which we called for, or I did, and I think several other people on briefing did. We were very, very overbought. Things had gotten way, I call it people getting way over their skis. The buyers had gotten way too over-enthusiastic on a very small subset of names. And we had the two big spring corrections, which for a while sort of unwound, it partially sort of deflated the FANG and the cloud bubble. And then guess what happened? Over roughly the last 6 months since those two corrections, they kind of slowly reinflated the FANG and the cloud bubble again. And really only one of the FANG names really didn't reinflate. And so anyway, that's my, I literally think, I don't think there's any doubt that's what's happened, is that now people are saying, and in fact, here's the deep thought of the day. What is the average person that has been kind of just trading FANG and cloud and got in late and wants recency bias to work? Because that's the easy trade. The easy trade is to think, hey, what's been working, yesterday and last week and last quarter and last year and the last 2 years, it's just going to keep working again. And that, everybody's hyper focused on the intensity of the recency bias. In fact, I would argue that recency bias has never been more strong in the markets than they are right now. Maybe 99, but even 99, I don't think you had as much of a recency bias perversion that we have now. But anyway, so everybody wants the FANG trade to keep working. Everybody wants Adobe to keep working. I'm being, euphemistic, but everybody wants the cloud bubble to keep bubbling. Well, what if it's done? What if FANG? What if we've seen long-term highs? Now will Facebook eventually go to a higher high? I believe it will. Google certainly will. Amazon, again, given just the durability and strength and size of the company, 2, 3, 4, 5, 8 years from now, it should go to a higher high. But what does the world look like? What are investors going to do if the FANG trade's dead? I mean, I think it is. I think it's been dead I think the first bullets went into it this spring. I think we got more bullets hit at this recently. I think, again, things usually work. There's always 4 phases to markets. There's 4 phases to the economic cycle. There's usually 4 phases to an unwind of a trade. So I think this is phase 2 of the unwind of FANG and cloud. And so I think people like me like this. I think the action is very good. In fact, I made, multiple years with the returns this spring because we had a minor rotation. just a minor rotation, which let hundreds of stocks rise, which had been held down, artificially because all the money went into FANG and no money went into anything else. And so if we have a few more rotations, which let other names work, you'd see huge catch-up trades and tons of things. But again, if you're still hanging out, if you're still trying to catch Netflix on dips and Amazon on dips and Facebook on dips and Tesla on dips, you might have a really, really tough 3, 4, 5, 7 years ahead of you. It'd be very similar to hey, if you were a guy still trying to catch Yahoo and Microsoft and Cisco dips post 1999, you probably busted out because those stocks never really bounced enough after huge sell-offs to really produce much of a gain. Unless you became really good at trading 20 and 40 and 50 cent moves on 20 and 30 and $40 stocks. But, it took, you tell me, I have to pull up a chart. I think it took something like 15 or 16 years for Microsoft eventually to get back to all-time highs again. That's a long time to wait. Most people aren't that patient. And that's a long time to produce way performance that's magnitudes under the market performance. So again, people can disagree with me. There's almost no way I won't be, or there's almost no way this won't happen. So we can't say there's no way we're always going to be right. In fact, we're always wrong in the markets. And then once in a while we get something really right. But the bottom line is there's just almost no way that FANG will unwind. I mean, or maybe said another way, there's almost no way that FANG will keep producing the same outperformance that it's produced in recent years. So because that's just what happens in markets. It's, the leaders eventually die of old age, they get tired, they get winded, they get overinflated, and something else has to emerge and become the next group of leadership names. And I would say this FANG and cloud leadership is probably one of the longest running leadership perversions that we've had. And I call it a perversion because it just lasted so much longer than a market cycle normally lasts. So I'll just kind of end it there. But again, I probably can't stress enough that if you'd probably better find something to do than trade FANG long. If you want to keep producing returns and having positive returns and especially outperforming the market over the next, year, 2, 3, 4, 5 years.
All right. So with that said, what are you doing? What are some of the ideas that you're throwing out there today based on... go ahead. Well, just based on... I know you'll talk about some of the names that you've always talked about, but I haven't seen you all that active really in this. Are you sitting out and waiting? Are you being patient, or are you just kind of chipping away at things.
Yeah, in fact, I have a really good post about sort of activity during market downturns. I just haven't posted it yet. I've just been busy kind of with the activity that I have done. I mean, some market sell-offs I'm very active. Some I don't. I'm really not, and it's because, one, I'm not worried about what I'm in, and price doesn't make me sell. Unlike most other people, price either makes me sort of sit back and hold and reflect, or add more. I don't sell. I don't get forced out of things. I'll sell something. I might get forced out of something if the company deteriorates. That forces me out of something, because that's a fundamental change in a company. I'm wrong on my view, and therefore I'm going to make myself sell something because I think the fundamentals are differently than I thought. But I don't trade on price. I'll sell on price. I'll trim on price. I'll add to positions on lower price. But price doesn't dictate what I do, and I know that might sound foreign to a lot of people listening, but it just doesn't dictate what I do. Again, valuation matters and price matters, but I'm one of those contrarian folks that the cheaper something gets, if I like it, the more I am likely to buy. There's probably 3 reasons I've been less active this sell-off. Here's the main reason: I just like everything I'm in. And overall, a lot of what I'm in really performed well. The only name that I would say performed exceptionally poorly, which was surprising, was MTSI. But generally, everything else, like Acacia, we'll just use this as usually when you get an 800-point sell-off in the NASDAQ, Acacia drops a ton. And there's no fault of the company. And that's another thing I'll talk about too. But some stocks just drop a ton when for every 200 points that the NASDAQ drops. They just drop way, way more. You could call it beta, but to me, we've moved off of beta. Algos don't really trade beta anymore. They trade liquidity. And so what I mean by that is on names where there's just not that many natural buyers, they just get rated to extreme proportions because they are seeking a bid. They being algorithmic market makers, are trying to force volume. And the only way to force volume is you get price to drop so excessively that you almost, like guys like me and people that run money that have my view, just say, okay, I got to go buy some of this now because it's just so ridiculously dumb. Whereas in the old ways, how things traded on the specialist system, if there's not really any buyers, but there's not really any sellers, the stock will just hold its price. And now stocks don't behave that way, but that's a different subject. But if you look at Acacia, just as one example, this is probably the best it's held on a relative basis into an 800-point NASDAQ decline that honestly I've ever seen. The company hasn't been around that long. Another one would be Twitter. Now, Twitter had already put in most of its damage before this recent sell-off. So aside from about an hour of one day where it traded down in the low 26s, if you just didn't do anything dumb on Twitter, it's $3 higher than it was at the lows. And it's basically back to where it was a couple weeks ago. You know what I mean? So in other words, Twitter came through the whole 800-point decline, and it's probably higher now than it was before the decline started because they kind of beaten up Twitter before the teeth of the NASDAQ decline. So I could go on and on and on, but generally speaking, that's the main reason I didn't really have a cause of a lot of activity. I like what I'm in, and I really like what I'm in. I think I'm positioned for the rotation that's going to come. I think roughly 80 or 90% of my names will benefit very nicely from that rotation. So I didn't really need to do anything. And thank goodness I'd been a fairly proactive seller, trimmer in prior weeks and months into market strength. So, but here's reason number 2. Usually these sort of sell-offs usually have a pretty good retest. They don't always, but I think people now are much more cautious. I think that the tone of the average person running money now is going to be a lot different for quite a few weeks. So I think the odds of another sell-off that's relatively sharp and that retests or even takes us to a lower low, I'd say is at least 50, 60, 70%. I would be surprised if we don't retest the lows and actually go to a lower low. And that's very typical of a very sharp sentiment drop. And then probably the third reason is, this is sort of an old, different people do different things. In many ways, I've made my year many months ago. So I'm probably less active this year than I am normally because I don't want to mess up my year. I already had a super good year. I had a great year by April. And so in a way, I'm just sort of managing gains. Now, hey, if I see something exceptional, something super attractive, either that's something new that I want to do, or if I just see something that's crazy in a name that I'm in, I'll take advantage of it. But, I think that's the biggest thing. I think sometimes people are far too active just because price is moving around a lot, when in fact, a lot of times you can just kind of sit through it and come out the other side looking better. And that's kind of what I think is going to happen. I think during earnings season, through the bulk of earnings season, I think that I'll end up making quite a bit of money by pretty much just not doing a whole lot. I think I've already positioned pretty well. And I might add to some things and I might short some things. But the bottom line is, there just are times where I think if you're positioned properly, sometimes the best thing to do is to let it work. And that's pretty much it. But there's lots of things that it's not like the recent sell-off really made things much cheaper. They just sort of have kept things, low that are already beaten up. I'm just trying to navigate and kind of see now kind of how I go into earnings season. That's the other thing too. It's like if that sell-off would have occurred during the teeth of earnings season and something had recently reported, maybe there'd be better trades. We're getting pretty close to when earnings reports are coming. So I like to make sure I've got plenty of ammo to trade during earnings season. So that may, if there's a fourth reason I just didn't do much last week, that's probably it.
All right, based on what you look at in your technicals and your sentiment indicators, do you think that we've put in the low for this particular correction?
We could have, because we got, NIMO hit minus 103 on a closing basis. Various other sentiment indicators got very, very low. But like I just said, if we have a week where we just have a bunch of earnings reports are bad, we could go to a lower low. I mean, I won't be surprised. I was kind of just, my gut was kind of thinking we could kind of go 12, 14, 16% correction. But by the way, I don't think we've put in ultimate highs, not even close. I think, in fact, if we put in ultimate highs, that would be extremely strange. Because usually what happens in, again, whether it's phase 3 or phase 4 of a market rally, which again, we're either deep in phase 3 or we're in phase 4, which, it's a long-winded, long-toothed rally, is you typically get an explosive type move, but you don't get an explosive type move in the former winners. You finally get a big catch-up rotation trade. It's the exact same thing I've talked about 2013 to spring of 14, which, by the way, that was kind of a final high for a fairly long period, for about a year, if not more. And then spring of 15 was definitely a final high for at least a year or two. So what happened is the big returns in 2013 through early 14, and then a reflex move in early 15 wasn't the former winners. It was stuff that had performed poorly that the fundamentals were good. So it was the catch-up trade. So that was in 2013. That was, Apple ended up being a big leader, but like a lot of the former leaders didn't do much. It was like new names. That's when Facebook was new and grew and got really cheap, and then Facebook was a huge winner. That's when I loved Facebook, by the way, 2013 through sort of late to early 15. Micron. That's when you could buy Micron at 6 to 8, and it went to 36. In fact, Greenlight Capital loved it at 32 after it had gone from 6 to 36, and they famously had to exit that position before it went back to 10. So the huge part of the rally in 2013 through spring of 14 was a huge catch-up trade. Was all the stuff that should have probably gone up prior that didn't participate went up, and we should have one of those. It would be highly, highly unusual if we don't have of the final phase of the rally, which acts more like that, where the former leaders, they might go up a little more, and they might not be net losers, but that doesn't mean they are net win, meaning they don't outperform. So, I'm looking for a final move, which is, okay, maybe FANG kind of ekes out gains, but it vastly underperforms the stocks that end up winning. And by the way, if you want to talk recession probabilities, we should probably do that. But because I think I've kind of said enough about FANG, I've said enough about cloud, I've kind of been saying the same thing on these stocks. By the way, though, I mean, it's been working. I mean, I've pretty much said avoid FANG for the better part of a year. And if you've been hanging on to the FANG names, they basically all topped out in early January. So since their peak in early January, they've been net losing trades. Some of them pretty big net loser trades. Tesla's been another one of the FANG contingents that's a net losing trade. And there's been plenty of others. I mean, again, I don't know, if you bought Adobe early in the year, you're probably flat to down, where there's lots of stocks that have gone up. So, you can ask me, we can talk more about that, but I don't know. If you need more imagination, if you're still hanging on, you still want to trade FANG and hoping that FANG's going to be the leadership group, you got to find something else to do.
All right. Well, I know you survey the semiconductor space pretty well, and Lam Research had a pretty decent outlook for the latter part of the year and whatnot. So I wanted to see if you could give me what your read-through was as far as what they had to say on their latest update.
Yeah, I mean, Lam isn't a name I will probably buy itself at this point. Although it's, again, that's one of the names I can't remember if Lam was definitely said short radar on it. I definitely said avoid it. I didn't personally short it. I did short Micron a couple times though. So I actually think if you want to start, and this is probably something I turned tail on this about a week or two ago, maybe 3 weeks ago. I think if you want to start getting bullish Micron again, you can. And I think the Lam result is points to positive things for Micron. The other name I would highlight is ICHR. That's been a pretty good name for me a couple trading times. It's pretty cheap, and they had an interesting report. They actually had a disappointing quarter last quarter, and the stock had a nice surge. It went from like 19 to like 26 on effectively a miss. It wasn't a bad miss, and the results were still. Again, I always look at results of what they are, not the headline. The headline was a miss. The guide was a miss, but the company's producing super good numbers relative to itself. So it was a pretty good miss, but hey, it was still a miss. They still guided lower, and the stock went up a lot. And I mean, they've killed that. I mean, they're again, I haven't heard or seen any bad news on ICHR, and this is in that semi-cap equipment space too. And again, look at low liquidity, boom, no buyers, boom, raid here, raid there. All of a sudden, the $26 stock is 18. Now it's had a little bit of a bounce, but like this is exactly the type of name. Which if I'm right, this thing could go up a lot. And this one's back on long radar for me. I don't have it, and I'm a little torn. I mean, to me, I don't need both Micron and this name. I could right now, right here, if I were to buy these, I probably would favor Micron and buy Micron. But this is pretty. I kind of missed this. I was looking at this like 2 days ago, kind of in the low 18s for a trade, and I would have caught a nice trade. I think I ended up buying SurveyMonkey instead. By the way, and it's about the same gain because I'm percentage wise I'm up 10% plus or close on SurveyMonkey. I think it'd be about the same on iCore. So, but that's a nice name. My read on Lam is that hey, Lam could work here. I mean, at least Lam has kind of done what. Yeah, I mean, heck, they didn't quite cut that thing in half, but they almost did. I mean, hey, that's what needs to happen to Amazon. That's what needs to happen to Netflix. That's what needs to happen to, Adobe. I mean, most of these stocks need to drop 30, 35, 40, 45%. And then they're kind of back to just at least a rationally overvalued level instead of an egregiously overvalued level. I mean, Twitter dropped 40%, and Twitter has way better fundamentals than most of the FANGs now. So, I mean, if Twitter can drop 40%, why can't the stocks that are far more overvalued and hyped than that? So, But Lamb put in a good beating. I mean, that name could work now. So the thing about Lamb, though, I don't know. I mean, they've had the reason I'm more positive on, let's say, Micron, is they pretty much know Micron is going to go into a good cycle. You've got a good handheld cycle coming. You've got a tablet refresh coming. There's probably a minor PC tailwind for Micron, not as good as it was 2 or 3 years ago, but you have at least it's a minor tailwind. So I don't know. It's gun to head. I'd probably favor Micron. I definitely know that Micron it's much more attractive on a valuation basis. So price to free cash flow is better. Price to sales is much more attractive on Micron. Micron's got a huge buyback. I think they'll probably be pretty aggressive. I hope they're not buying too much stock back at 50. If they wait until if the stock were to have one more leg lower and then hit the buyback button, I think that they'd be very well served. They're probably buying stock back here though as well, low 40s. So yeah, I mean I think Lamb is good for Micron. I think that's the best way to say it. And if you don't like Micron, take a look at Ichor.
All right. Are you still short Adobe? They had a pretty decent outlook, I think, last night, was it?
I am. I mean, I will probably be short Adobe until I just sell a bunch of my tech holdings. Honestly, I think I need some hedges. I mean, honestly, okay. Did Adobe say anything that we didn't know? No, they didn't raise numbers. They just sort of affirmed numbers. So Adobe didn't give anybody any new news. So I don't know. I kind of think Adobe's probably going to trade like Netflix is trading today, where it had a big reflex rally on the earnings, but today is it even up a third of what it was last night? I think Netflix is only up about a third of what it was at the highs in after hours last night. So I think Adobe, I think Adobe will drop about 40% from its highs. So, just use easy math. Okay, 280, roughly 140. At 140, I won't be interested in shorting it anymore.
All right. And your target on this one, I can't remember what it was on Adobe.
On Adobe?
Yes.
I'm just saying that I don't really have a target, because the target, the target's probably about what I just said. I think it's still overvalued, but just way less overvalued at sort of 140 to 160.
Oh, okay.
So, like I say, I probably won't cover my short until the stock roughly gets cut in half from the highs. So it was 280 at the high, 140's half. Again, that's 50%, not 40. So, maybe 160, 165-ish or something. By the way, that doesn't, what if Adobe goes into a period where earnings aren't good? What if they miss? What if growth slows down? I mean, I'm giving them the benefit of their current growth rate, which is pretty good. What if they were like a 6% grower at one point? What if they kind of go back to 6% growth? I mean, nobody's valuing Adobe at 6%, at a terminal 6% growth rate. I mean, if you value Adobe at a 6% growth rate, I don't know, maybe it's worth 85. So I haven't done that math on it, but I'm sort of giving the benefit of the doubt. And hey, if you want to say they're roughly a 15% grower, I think 140 to 160, 170 is kind of where they should trade. I mean, put it this way. If I'm wrong and I don't eventually make money on Adobe, then I'll just end up making obscene returns on Cloudera and Hortonworks and Twitter and DBX and the things I own that are way cheaper. So I don't really worry about Adobe because honestly I'd probably end up making way more money if it goes to 320, because that means that things I own will finally have a chance of going up far greater percentage than Adobe. But yeah, I'd be pretty shocked if Adobe doesn't at some point in the next, a reasonable time frame, not 5 years, but more like, I don't know, 2 to 4 or 5 quarters, trade at roughly half of where it's currently trading. Maybe it'd take a little longer than that, but time will tell. We'll see.
All right, just got a question.
I mean, the best thing I would say about Adobe is, it's just like Fang. If that's your best idea is to buy Adobe here at 257, I just think you're in a very, very hard time making money.
I know you've covered this in the past, but could you update. One of the listeners had a question. When you talk about the rotation out of FANG and what are some of the things that you're talking about? Again, this is probably rehashing a lot of the things that you've talked about, but since we have the question, maybe it wasn't quite clear to whoever addressed this question.
Well, I think the easiest way to say it is basically it could rotate into hundreds of names that essentially have FANG's growth rate and higher, but trade at 1/3 the valuation of FANG, or 1/2 the valuation of FANG. I mean, that's really the easiest way to say it. If you want to broaden it out, I mean, I put on some Goldman Sachs call spread yesterday. I think stock's up like 12 points. And again, I don't really play for the short term. I mean, I have plenty of time on that trade, and I think I'm going to max that spread because I think Goldman will go to 250 or so within weeks or months, and I'll max the spread out. But I think that finance names could catch a big bid. I really like the Goldman report. I really like the Morgan Stanley report. And I've been waiting, as you know, I've been waiting on those names. And what was that? Yes, again, roughly 12. It was the 200 teens something. I mean, it was basically about 12 lower than it is right now. I mean, I remember the exact. It was up $1.57 from the day before after they reported a blowout report. I'm like, okay, I got to buy some of this because up $1.57 on that report. I felt like the market was giving me Goldman for free. So. Honestly, I kind of now wish I would have done more, but I can sprinkle in some other finance, but the finance group, remember the last big finance rally we had was started about this time last year, by the way. I'm trying to remember the exact, there was a pretty good catalyst for it too. I can't remember off the top of my head, but the finance stocks could have a huge catch-up trade because so it's deep thought. Number 2 for the day. If this really was a sell-off that was a 100% result of Fed rate hike fears and Fed overshooting fears or just rates rising, then guess what should have gone up a ton? Finance stocks. I mean, because we have seen this. I mean, finance stocks can trade green when the Nasdaq is down 2%. I've seen it tons of times. But guess what? Guess what traded really rough during the last correction? The finance sector. So it's complete. That's why I don't think the sell-off had anything to do with rates. Because if it had to do with rates, the finance stocks would have gone up huge. I mean, we would have seen Goldman, Morgan, J.P. Morgan, Citibank, Bank of America. We'd seen all these names green day after day after day while the Nasdaq was selling off, and they weren't. They were down. In fact, they were down basically a roughly similar percentage to the stocks in the tech sector that sold off. So, that's a group I think that could win a lot. Another area, but again, the easiest way to say it is there's tons of stuff that has the growth of FANG or more or superior growth of FANG, but trades at roughly 1/2, 1/3, 1/4 the valuation of FANG. And there's hundreds of names like that that's been left out of this rally. For whatever reason, they just have, but they won't keep them out forever, but they can keep them out for a long time. And even earlier this year, I mean, you could just look at what worked post the sell-off this spring. You had a big move in Twitter. You had a big move in a lot of other cheap tech names. You had pretty good bounce in bios. You had a big again, the finance group was the most clear winner from probably like last December into like March, April. So stuff like that. I mean, here's another one. Here's a name I probably won't go long, and I probably will regret it. Again, I watch and follow hundreds of stocks. FCX. So remember when global reconstruction and U.S. reconstruction and the rebuilding of American bridges and highways. Remember when that was kind of the in-rage trade or in vogue trade, but I think it was only in vogue for about 8 weeks, by the way. I mean, maybe 2 quarters, it kind of worked. But you get Freeport. I mean, look at Freeport. I mean, this thing's been not quite cut in half, but Freeport was $20 in January of this year. It's $12.50 now. So there again, that doesn't really make a lot of sense. Now, and that move, the catch-up move they put on, gorgeous catch-up move, probably most of that was deserved. So they were a stock that lagged and lagged and lagged, They probably put in 1 or 2 years worth of performance in 6 weeks, and then they gave it all back again. So, stuff like that. I probably will regret not buying Freeport, because this will probably go to 20 or 22 or 25 before, again, it gets rated again back down to here. But the bottom line is that's pretty easy long, I think, right here. So stuff like that. There's just tons of things. There's, just put a little imagination, trust yourself, be a little imaginative. Do some screens, find some beaten up stocks, and chances are there's probably nothing wrong with them, except they've traded lower. So, again, one of the fallacies, and it's just become a very popular fallacy in recent years. Again, it's just like recency bias, is people like to project that something's wrong with the company because the stock price has gone down. Well, most of the time, there's the companies don't change that much. A good successful company has been around 60 years, probably hasn't radically changed in 3 months. Even though maybe the price has gone down 35 or 40. 18 to 12.5 looks pretty harsh for Freeport. I doubt that company's operating 35 or 40% differently today than it was 6 weeks ago. Right? So, what was Goldman's high earlier this year? 273. Do you think Goldman's radically changed their business from the time they were a $270 stock to the time they were a $212 stock? I doubt it. In fact, I think Goldman's business is probably better now than it was at 273. Why? Because interest rates are higher. Why? Because interest rates will probably go up more. They get more spread. They get more net interest margin. Hey, if some volatility comes back into the fixed income market, then they make a lot more money in their fixed income trading. If there's some market corrections or two, they make way more money on their equity trading. Again, I could go on and on and on. The setup for Goldman, I would argue Goldman's a much better company at 215 than it was at 270 8 months ago.
All right, so in the midst of this pullback, what names really stand out to you that are in your portfolio or you've been following that you really had to take advantage of, or would advise taking advantage of?
I won't talk about Goldman because I just did.
Right, not that one, but some of your other ones.
I still feel maybe even better about the fiber optic setup because again, what's happened when this group always sells off when tech sells off. In fact, I've never seen fiber optic stocks go up when the Nasdaq drops. No, there's certain days. Hey, can a fiber optic stock be green if the Nasdaq's down 40 or 50 points? Sure. I literally have never seen, no matter how good the setup, no matter how bullish it is, no matter how much growth over prior year these stocks are exhibiting, if the Nasdaq drops 800 points, these stocks don't go up. They go down, and they go down more than the market does. But 5G, man, 5G baby. My theme for next year is like 5G, and so that's we're in maybe inning one of the coming 5G. I don't even actually know if we're in inning one. I think we're in the pregame warm up for 5G, and we've seen some of these stocks act pretty good so far. Qualcomm's notably off lows. That's Sierra Wireless is notably off lows. The fiber optics group will benefit handsomely. Acacia's notably off lows. So basically anything fiber optics, anything 5G. By the way, Micron, again, I think Micron benefits from all that because it will require more compute power, more memory, more storage. Every device that's an Internet of Things is the other big thing. Every single device that gets added to what is the intranet of things in Internet of Things creates more data, more storage, more analysis, more real-time analytics, more AI. That's the other thing, AI. If you can find cheap, the only cheap AI name I have really is Twitter. But I'm watching things like AYX. I'm still, I watch Splunk every day. I'm not in Splunk. I sold Splunk very well. I'm watching things like Data. But the only real cheap AI value is Twitter. Most of the AI names kind of went almost haywire to the upside. But yeah, fiber optics, 5G, Internet of Things. Basically, these are areas I pretty much know are going to be growth areas while other areas of tech that were the high growth areas start having decelerating growth. They will still grow. Facebook will still grow. Google will still grow, but the rate of their growth is going to decline. Whereas the rate of growth for 5G, the rate of growth for fiber optic deployments, the rate of growth, I mean, some cloud could have accelerating growth. I mean, I would be shocked if Hortonworks, Cloudera doesn't hold their growth rate or maybe even accelerate their growth rate. But by the way, I've gotten some questions on that. They just completed a merger. They just had some good earnings reports. Well, again, these are stocks that these are not darlings in hedge fund and mutual fund portfolios. So again, when the Nasdaq drops 800, 900 points, these stocks are not going to go up or hold. They're going to go down roughly 3x what the Nasdaq goes down, or for sure 2. So pencil in, hey, if the Nasdaq drops 10, those names are going to drop 20%, and they might drop 30. That's just the way these individual stocks trade. So those two could be pretty spectacular. And a possible group, and I've been wrong on this, 100% wrong, but I still think alternative energy. And you know what might be hurting this group? I actually thought of this over the weekend. Is kind of if Tesla is really unwinding, if there's actually real fundamental troubles at Tesla, maybe that's pressuring the solar industry a little bit because they own a fairly large player in the solar space, and I don't know. That's just one. I keep thinking that there's just too many reasons for solar to have another big growth move again. And somebody mentioned Bloom Energy. I've been digging into Bloom Energy a little bit. I don't know. But I've been 100% wrong on. Well, it's not like I've lost a lot of money in the space, but it hasn't done anything for me. So that would be I guess you throw in a haymaker. There's a possibility that alternative energy could be a big winner. By the way, I will add this. In every single late cycle rally, alternative energy typically has a big trade. So if we've seen ultimate highs and the market doesn't go to a higher high and we don't have a big catch-up trade, the next trade is basically a flat to lower market in a somewhat recessionary type trade, and solars don't go up, this would be the first time in my lifetime that the alternative energy stocks have not put in a notable huge catch-up rally at the end of a market cycle. So that's why I'm pretty sure they will do it, and I'm pretty sure. And by the way, I will also say this: usually the solars and alternative energy stocks are a great indicator for the end of a market cycle, because they usually get really hot, they go up a lot, they get super excited, and even lots of weird little junk stocks in the alternative energy space go up a lot. And that's usually when you probably need to be getting out of most of your stocks. When they're late, when the solars are at the end of their rally, usually that's you. But you probably better have sold a lot of your big tech and biotech winners by then, because that's when Micron went from 45 to 10, is when solar unwound. You know what I mean? Mm-hmm. That's when the fall of 2015 and the spring of 2016 huge tech correction hit, is when solars finally caved in and unwound, because they were the last group to go up. So I kind of think that trade will hit again. But it's a tougher call, because they frankly probably should have worked by now, and they haven't. But sometimes things take longer than they do. So I would you can ask whatever you want about other questions. I'm just going to insert this whole recession fear thing. There's all this talk. Oh, we're going to have a recession. That's the next big trade. Oh, we're going to have a recession. Fed's going to put us in a recession. If stock price declines X, it's going to signal a recession. Blah blah blah. All I'll say to this is, when are the popular media, if they've been first on an idea or pound the table on an idea kind of before other people, when have they ever been right? Then the answer to that is never. They've never been right. So usually by the time the popular media recognizes something like, oh, hey, we should be worried about a recession, well, you're already in it. You've probably been in it for 6 months, and a lot of the damage has already been done. So I doubt the people screaming on CNBC that the next big trade's recession. I have a hard time believing they're going to be right, because they would have forewarned the world pretty much before anybody else.
All right. Let's see. we've got earnings coming up. What are the big ones that you are most looking forward to hearing, if not just from a trading perspective, from a color perspective on the whole group?
Well, I had just finished over the last couple of days looking at earnings. I have to this is going to be a quarter where I'm probably going to do less preemptive trading on a lot of names. But U.S. Silica reports next Tuesday. That's something I might get long before the review. I do have a little bit of that, by the way. That's a very, very slight loser. I just have sort of my intro position on that, kind of a toe dip position on that. I think it's about 3 or 4 points higher, by the way. But that's one. By the way, energy's traded poorly. I don't think we have enough time to talk about energy. That's another group that could actually do really well because relative to how well oil prices have hung on, a lot of oil stocks haven't really traded very well. But that's a name I like. Corning also reports that same morning. They had a really good report last couple quarters, and they've given a big chunk of the gain away. And the cycle for Corning looks pretty good. They're kind of a tertiary not 5G fiber play. The fiber business isn't near what it once was for them. So people still think of Corning as a fiber optics company. They don't really know it very well anymore. But it does have a fiber optic component to the business. But they're just sort of in a better cycle. Another cheap name that I still think has a lot of untapped value, I think this is very similar to a NetApp, which is NTAP, is Juniper. Juniper reports next Tuesday afternoon. That's another stock that's a very undervalued name. So for example, nobody probably really wants to buy Juniper. Nobody's very excited about it. That's exactly the kind of company that could do very well. So again, FANG could trade sideways to down, and Juniper could go up, go back to 40, 45, something like that. It's a very cheap stock. So then we have some names I don't like that much, like Texas Instruments and things like that. The big day is Thursday, but on Wednesday you also got Checkpoint. I still like the cybersecurity stocks that I'm in, but Checkpoint I think could be an important report. The other report that I'm actually interested in now that I was never interested in really most quarters is SiriusXM. They report Wednesday morning. I'm going to start paying attention to those reports because I haven't decided, is that a name I want to hold? I still have Pandora. I still kind of hope that Pandora gets a higher bid. I don't think they will though. So, but at some point I have to decide: do I want to transfer my Pandora holding to Sirius, or do I just want to do something different? And I haven't decided, but I'm going to start listening to some Sirius reports and see. Trivago also reports again. That's another one. They had a big move higher off kind of a shocking low. And they've given up. I mean, they probably chopped the gains in half on that name. I don't think there's any reason to. Again, that's just market dynamic selling. So that's a report I'm interested. AMD I still think is a short. F5 Citrix are a couple short names. They report Wednesday afternoon. Microsoft, which I'm still short. By the way, I might stay short Microsoft a long time too. I think we're getting very, very long in the Microsoft bull trade. So yeah, the only thing I don't like about it, I don't know if it has quite as much juice as like things I've nailed, like Varonis and New Relic and things like that. But I don't know. I feel pretty comfortable. I feel like it's same thing. I mean, it wouldn't take that much for that stock to drop 25 or 35%, which nobody expects it could, by the way. And then you got a key. The ServiceNow is always a key report. But as far as names, I'm more interested in. It would be the security stocks that I own could get some pin action off Checkpoint. I'm definitely going to listen to Sirius. Definitely going to listen to Trivago. Some of these other names, I just kind of watch how they trade, and they might set up as shorts. And then Thursday, Twitter's Thursday morning, and then Amazon and Google are Thursday evening. And so Thursday's also there's a bunch of names reporting on Thursday evening as well. But those are the keys. I think Twitter, and there's some other interesting names too in the morning. But so those I would say the three big on Thursday is Twitter, Alphabet, and Amazon. And by the way, people want to. The one FANG name that is buyable long term is Google. I don't own any Google right now. I still would rather buy it about 20% below. I think I've told you between 800 and 1,000 is much more attractive to me. Obviously, the closer to 800, the better. But I could own Google here. I mean, Google is like kind of a harbinger of value. So if I kind of felt skittish and just felt like I still wanted a long but wanted a place to kind of hide, I could own Google. Because, I mean, you know, in a really, really severe recession / correction type market, which we will have at some point, you know, Google's name would only drop about half of most other things, especially from 1100. You know, but I just have a really strong sense I'll be able to buy this thing somewhere between, especially between like 850 and 950. I don't know. I just have a feeling that I'll be able to buy it there. You know, maybe there will come a period where people just aren't as excited about Google, and I'll be able to, you know, get basically this would be another thing that would be highly unusual. It would be highly unusual if Google doesn't put in a normal sort of Fibonacci retracement, which almost all stocks do. I mean, I can't remember the last time Google had like a 38.2 or 50% Fibonacci retracement for not like an ultimate low, but just a recent low. So like, you know, the 2016 low was 670, 680. You know, we're a long ways from a 50% retracement from 680 versus the 1290 high. So, you know, again, it's just, I mean, even just a weekly long-term moving average that the stock used to hit like once every 2 or 3 years, hasn't hit for a number of years, would be like, you know, I don't know, like 100 EMA on the weekly. I mean, there's just certain things that normal stocks would do that a lot of stocks haven't done for a long time. So, you know, if we have a normal type regression, the mean type event, I think we'll be able to catch Google, you know, again, for sure 10% below here, if not 20 or 25. And I would be a very, very strong endorser of Google at that, you know, 850 to 950 area.
All right, I want to bring up one that you don't talk a lot about, and it is on one of the listeners' minds, and they reported yesterday, and that's IBM. Do you have any thoughts coming out of their earnings?
Well, I would rather be long IBM than short IBM. I think that, you know, typically if you buy IBM on a post earnings drop, it's almost hard not to make money, because, you know, if you just let's just take I mean, we should just put a friendly sort of bet versus the world on this. If you buy IBM here 136 and you hold it 6 weeks, I bet it's a profitable trade. Because it probably just, if nothing else, it probably goes back to like 145 to 150. I mean, it's a really boring trade, and there's no sex appeal to it. But, you know, it's just IBM kind of just trades in a range, you know. And honestly, I actually think IBM could, this is probably an unpopular and highly contrarian opinion, I actually think IBM could go on not a tear, but a growth cycle again. You know, the company's had some pretty decent growth cycles in the past. Here's the problem with IBM. I don't know, and maybe they're actually doing the right thing. Maybe it's not a good time to do M&A because prices are high. M&A is expensive right now. You know, people that are doing, well, I mean, M&A wasn't expensive for Sirius. They bought Pandora cheap. There have been some good buys. I mean, CRM bought Mule for a very good price. So I don't know, but IBM just hasn't bought anything. The only way this company is going to grow and grow dynamically is they're going to have to do what they used to do. They're going to have to do what CRM and Oracle and Google do very well, which is buy assets and buy other companies. And I just haven't seen IBM. I think their last couple deals just weren't very good. So that's really who should be at the leadership of IBM, is a really strong M&A visionary. The organic work that IBM is doing, I think, is relatively good. I think the divisions of the company that are there, where they're trying to grow more of their cloud divisions, their AI divisions, I think they've developed pretty good products internally, but it's not enough to move the needle. That's a big ship to turn. So I just don't know. But if everything they're looking at they think is way too expensive and they're just waiting, and maybe that's a sound choice for a while. But yeah, I'd rather be long than short IBM. But for me, it's like I think Qualcomm. So if I want to play safe, if I want to play safe ball, and just say, hey, what's a super cheap, super strong fundamental company that produces magnitudes of cash flow and I think can trade way, way higher, which actually has growth that I can see coming. I think like Qualcomm's just the easier play. So it's literally too easy for me to find lots of other things to buy instead of IBM. But if I was running $2, $3, $4 billion and had a portfolio of 115 to 130 names, I'd own IBM. In fact, I'd probably own it, and every time it trades high, I'd probably write calls on it. So I probably would have been writing calls on it earlier this spring at like 155 to 160. Maybe I would have written calls on it at the recent 150 highs, like written 150s or 155s. And then when it's cheap, you just kind of leave it alone. You let it go up again. Maybe you try to trade it. But I would say that the setup for IBM for long-term conservative investors is actually pretty good. Another name I would probably prefer. Would I rather own Celgene or IBM? It's pretty easy for me to own a Celgene. But, that doesn't mean you couldn't own both of them, right? Same thing, I'd probably rather own Gilead. This is just me personally. I'd probably rather own Gilead than IBM. But there again, if you have enough money, if you're running money, you can own both those companies. So I kind of like IBM, but I don't like it enough. I'd rather buy a Pivotal. I'd rather own Twitter. I'd rather own my fiber optic stocks. But the easiest one for me is Qualcomm. Because again, I'm mostly running money for myself. So if I want to be more concentrated than a discretionary pool of money, I can be, right? So I would rather just concentrate and have most of my large cap exposure. I'm kind of echoing my Google in Apple trades of yesteryear, by the way. So, when I felt those were my favorite stocks, I owned pretty large positions in those names. And I didn't own a bunch of other large cap because I felt like my Google position or my Apple position was fine. And so now I'm kind of like, that's where I am with Qualcomm. I'm like, well, I own a decent chunk of Qualcomm. I could always buy more of it too. I think it's going to $100 minimum, maybe even a lot higher. And it's got the cash flow. It's got it's got all the valuation metrics I look for. In fact, the valuation metrics are way superior to IBM. But the bet on IBM would be they get the ship turned and they start surprising to the upside again. IBM surprising the upside for two or three or 4 quarters could easily go to $180. And that'd be a pretty good move in a relatively short period of time if they can execute.
All right. I think you said earlier that you have an update coming on how to navigate through some of this turmoil and volatility in the NASDAQ. An update that you're going to post on the page.
Oh, yeah. Well, it was more about basically don't get sucked into groupthink. I think the title is something like that. I got to look. I've got the note basically done, but I haven't like polished it off yet. But yeah, it's basically that. It's like don't get sucked into groupthink. Especially during times of turmoil. In other words, here's I think one of the phrases or one of the points in it is, what does the average person do? The average person probably trades more, not less, during corrections. The average person probably selling more than they're buying during market corrections. And the average person is probably letting the correction dictate their actions, right? So again, that's probably what the crowd's doing. That's probably what the masses are doing. The masses are the averages. The averages are going to produce average results, and average results in the market pretty much mean you underperform. So unless you're an indexer, but I'm talking about traders and active participants, right? So if you're operating and achieving what the masses are doing, you're not doing very well. So why would you want to be the masses? Why would you want to be average? Why would you want to underperform? So if you're going to take the time and energy and stress and all this stuff and to try to make a lot more money than indexing, and hey, you're listening to us and you're doing all this stuff, you want to outperform. You want to beat the indices. You want to be exceptional. You don't want to be average. So don't do the things that the masses are doing. Part of the reason markets sell off so quickly as they do is because that's what most people are doing, right? So generally, now they're in a true crash, in a huge nasty correction, that's the one time you want to be the first out the door. You don't want to be in the middle out the door. You don't want to be last out the door. If you're last out the door, just hang in and hold on because you've already suffered all the damage. So But that's the only time. The only time that you ever want to be first out the door in the sell trigger is something truly horrific or early out the door. I don't, it's also hard to outperform if you're constantly in permanently positioned for the next crash. Because, I've lived through a lot of crashes. I wasn't fully invested, but I didn't sell nearly what I should have sold in 2008. And you know what? About 10 months after the bottom in 2009, I had more money than I had going into the crash. So, and I didn't operate perfectly. I had a full-time job back then. I couldn't focus on my stock stuff as well as I wanted to. I made plenty of mistakes. But you know what I did? I held. I had Apple. I'm trying to think in fact, I had a bunch of, I think I told you this story. I was buying Finisar, which I thought was like the most unbelievable buy in the world at like 450 or something like that. I think the intraday low at whatever the ultimate low on Finisar was in 08 and 09, I think it was like $1.50 or something. So I thought it was a genius when I was buying, and I had avoided, with probably half my money or more, I had avoided a lot of pain. Like a lot of market pain. So, hey, I was better than most. I got out before a lot of people did with a big chunk of my money. And I'm like, oh, this is so odd. Look at all this. Look at how much Finisar I can buy. Well, it went down like another 65, 70% from where I bought it. But you know what? I was selling Finisar at 35 to 40 bucks in the spring of 2011. So that was, literally just a little more than... Was that a year and a half? And then, by the way, I sold plenty of it between 25 and 30 too. But I think the very worst I sold Finisar from the 450 buy was, I think, 22. So that was my worst sale from the 450. I think my best sale was like 40 something. I think the ultimate high for Finisar was around 45 for that cycle. So there you go. Had I panicked and had I sold all that Finisar that I bought at 450, had I sold it at 2, I literally might have had I would have had to recover. I would have had to save money from income and rebuild myself, right? So, and that's just one tiny example. I think I was thinking about selling some Apple back then. I can't remember all the prices, but I think Apple's ultimate low split adjusted was like $88 or $82. I easily held Apple for 40, 50 points of downside during that whole decline. But the reason I kept Apple was every time they'd have a quarter, it was like, that's when Apple was growing, by the way. Apple had like 35, 40, 50, they might have had 75% year-over-year growth during the crash quarters. That's when they were in their hyper growth phase with the iPhone and stuff like that. So, and by damned, I'm like, there's no way I'm selling a share of Apple. They just put this quarter out, and I'm sure the stock's crater and blah blah. I just didn't do it. I did not operate like the masses. I would not do it. I will not do it.
All right. Well, I'm sure you'll have even more to say in that post, and I look forward to reading that one.
Here's just a closing thought.
All right.
Has Warren Buffett ever sold the bulk of his positions ever during a market crash or any correction?
Probably not.
No. In fact, I don't think he even sells. Again, my guess is Warren Buffett, to the degree he's selling, he's typically selling kind of in periods of exuberance. So, he probably starts looking at buying into most corrections, into the teeth of correct. But in fact, he waited, and then he gets better deals too. So he basically waits for his phone to ring and says, hey, do you want to do this unbelievable transaction that nobody has access to except you? And then he says, okay, I will. Right? So he's kind of in a different position. The bank deals that he was able to negotiate, that bought banks, huge bank stakes for him in the teeth of 2008, 2009, literally nobody else on the planet had access to those deals except him. But he just sat back and waited, right? And he waited for the opportune time to buy. But did he sell anything? I doubt he sold anything. This whole idea that you have, just because you think a market correction is going to happen, that you have to unload huge chunks of your portfolio, is that even really right? I like to. I like to trim. I like to sell. I like to have. There's no better feeling than having a lot of cash before a big market sell-off. But I think honestly, I think a lot of times, even the best of us, even the pros, I think a lot of times, sometimes we just get lucky. Like we don't really plan it that way. We just kind of get lucky, right? But lucky, luck, the better prepared are lucky more often. But I don't know. I mean, again, I don't think Warren Buffett has ever been a big seller in front of any huge market crash or correction. He still outperforms pretty much everybody. So, and even when he was a younger guy, when he was in this huge growth phase, producing the really beating returns in industry and beating, I don't think he's ever really been much of a seller of stocks. So now that's the thing. I think if you hold the right stuff, it's not that you won't avoid the sell-off. Some stuff might hold better than others, but it's really the recovery aspect. It's that you'll take the pain of everybody else. Maybe you'll take even more pain. But then when you get the bounce and you get the recovery move, your recovery move is just profound. I think that's the difference. I mean, that's what I look for. I don't necessarily look for things that I do think a lot of my names will hold better if we have a terrible downturn, but I can't say they will. But what I feel like, I think a Qualcomm would end up coming up a lot more than, let's say, if I held a big chunk of a Vago or something, right? So, and I literally think about that name by name by name. I mean, hey, there's a reason I own Twitter. I mean, Twitter's going to be more volatile, but I think Twitter now has better fundamental growth dynamics than lots of. So what was the company somebody out? IBM, and there was another one. But yeah, I mean, IBM's another one. Even if I thought IBM was a really good buy, I probably think Twitter's a better buy, or will perform better, will have more growth going forward, things like that. But yeah, no, I'll put that up there, and it just. There's no reason you necessarily have to do anything just because prices are moving a lot. Now, sometimes it's a good thing to do. It's, hey, if you have cash, it's good to deploy it. If there's things you want to buy, it's good to buy it. And hey, if there's something maybe that you should have sold, like if you really something that you should have sold already, then hey, maybe it's a good time to do a swap trade. Sell something that you probably should have sold already and buy something that should already have. If anything, those are the trades I might do as well. But yeah, I mean, just because price is moving doesn't mean it should dictate your activity.
All right. Well, I think we'll check out on that note. As always, Sean, you bring the thunder and good ideas and all that stuff. We will be in touch, I'm sure, early next week.
No, this is good. Like I say, I kind of think if nothing else, now the earnings setup is much more dynamic. I think things can move more. I think good reports have a chance of being rewarded more. Again, the only way the market was actually going to go up again and have a meaningful up move was if we have a reset. Again, I'm just going to close. I don't know if we've had enough of a reset yet. We'll see.
Well, we've got the NASDAQ in positive territory. Triple Q's up 0.2%. So maybe we did put in a short-term bottom. Time will only tell, but at least it gave people a chance to get in on some of these tech names at a pretty, at least from a stock price perspective, cheaper prices than what they would have heading into earnings season. So maybe we did reload. Maybe the
absolutely.
market did get a chance to reload.
I think that's it. I think the setup is now a lot better. I think I might even said this in the last call, is that if nothing else, that I think going into earnings, the bar has been lowered. So I mean, had we gone into earnings where we were with no correction in front of the quarter, you'd have had. I mean, what would have had is what would have happened is what just happened. You would have had good reports just get sold off. And we, they would have corrected maybe one by one, name by name by name, instead of the whole market.
All right. Well, you got a busy week ahead. I'm sure you want to start at least preparing for that. And we'll check out on that note, as we'll give the listeners a chance to prep for the FOMC minutes and see if there's any new color there. As always, thanks a lot, Sean.
Take care. Have a good day.
Hey, you too.